We're back, baby. The Dividend Diplomats. We're ending 2022 in style. Today, we're going to talk to you about two undervalued dividend stocks that are huge dividend payers with very long dividend increase streaks that are showing signs of undervaluation. Let's gear up for the holiday season and maybe put some dividend stocks into your stuffing.
Ho, ho, ho. Merry Christmas, everybody. Santa's here bringing you dividend stocks, guys. We've got the two stocks that Bert just mentioned, deeply undervalued. Stock market is dropping. Fed, we hear you. We see you raising rates, going to raise rates one or two more times next year, plateauing in 2023 and decreasing into 2024. But guess what? That just opens up opportunities to buy passive income for less money, because that's what we do here on this channel. Bert, hit it.
All right, let's go first. What did the S&P 500? Let's hit this quick recap. It started the week at 39.50, ended the week 38.50, popped up at the beginning, and then it all came crashing down after Mr. Powell opened up his mouth in the middle of the week, stoking further recessionary fears, which people were hoping we snapped out of it. Not so fast. But you know what? When others are fearful, what are we doing? We're running into the market. We're finding those great long-term stocks that have shown that they can increase their dividend through good times and bad. These are the opportunities we love because it gives us a chance to keep buying and building these solid dividend stock positions.
Exactly, guys. Oh, by the way, please subscribe to this channel. Give this video a thumbs up. Bert and I are rocking the diplomat mugs right now. We're both actually, I think, Bert, you and the fam are under the weather. I'm still under the weather.
Oh, yeah.
I wanted to reach for a beer right now, but I'm just like, you know what? Getting better is probably a better priority.
Yeah, if Landy's going to be reaching for a beer while he's still sick, this video better get 1,000 likes. That'll be when it's worth it for him to make the sacrifice right now. So you're right, though, Landy. This is the best time to buy. This is the best time. We're excited. We are pumped up right now. And how do we find the stocks that we're looking to buy? We use the Dividend Diplomats Dividend Stock Screener, 3 metrics and a bonus metric. 1, PE ratio less than the S&P 500. 2, payout ratio less than 60%. 3, history of increasing dividends. And that 4th metric, that bonus metric, the dividend yield, the cherry on top. We don't look at yield first. We want to make sure we're getting a quality stock before we look at how much they're paying you.
Now, guys, keep in mind, you can't predict where the market's going. You can only work with the facts you have at hand. We've got undervalued Dividend Aristocrats stocks here to talk about. And the Dividend Aristocrats have increased their dividend for 25 plus years without stopping. And that's exactly what you want, your dividend income stream, which we think is the best form of passive income to continue to grow without you having to do anything during tough times like we're in right now. Again, recession is here, but they're still not saying it yet. They still don't want to pop the cherry on the word recession.
I know it'll come soon, and hopefully by that point we're looking out of it. So, and we'll be looking back, laughing. Oh yeah, we were definitely in a recession, but we're out of it now. Things are looking forward. So, what 2 stocks are on my watch list as we're going into the week? Number 1, Rowe Price, ticker symbol TROW. Man, Lanny, it feels like this stock has been on our watch list all of 2022 because the asset manager has been beaten down, obviously, because you don't earn fees on assets as they lose value. The fee income you are going to get is going to decrease as the fees on the total assets under management drop too. That said, we still love Rowe Price. They're a dividend aristocrat, like you were talking about, Lanny. They're one that when the market comes back up, we should be riding that trend in the other direction. You should see that flowing through the income statement that way.
Exactly, guys. Maybe we'll see $100 per share. Who knows? But right now, at $110.52, really showing some strong undervaluation. The company itself has a great balance sheet. Again, they've been through all of this before. They've got great dividend diplomat stock metrics. I mean, Bert, that first metric of price to earnings ratio expected here for Rowe Price at 110.52, again, down 43% this year. Expecting $7.24 in earnings. Price to earnings ratio is still only about 15.
Yeah, below the S&P 500, not the cheapest, but still at a discount compared to the market. That's what we look at when we look in this first metric. Number 2, the payout ratio. Their annual dividend is $4.80. Divide that by the 724, payout ratio 66%. So it's snuck up a little bit above our 60%. So it's something worth watching going forward. But the alarm bells are not ringing now. If it gets above 80, 90%, then, Lanny and I might have to have a different conversation about T. Rowe Price.
Yeah, again, they're over the threshold, obviously because expected earnings are down. That's going to happen. But again, I think, there's still some room to not just pay it, but, maybe some low growth going into 2023. But hey, that dividend growth rate, guys, that third diplomat stock metric, increasing dividends for over 35 plus years on this Dividend Aristocrat. The average rate right now is still over 16% over 5 years. Obviously, we think it's going to be a lot lower going forward as the market continues to stay down, flat, down, up, down, flat, not really popping. So there might be a few years till we get back to that dividend growth rate. But again, they continue to grow nonstop without pause.
Yeah. And that last metric, the dividend yield, 4.34%. So when the price came tumbling down in the last few weeks, that yield popped up again. That's a nice, juicy yield for a company that averages double-digit dividend growth. So that's a huge dividend factor. 4.34% yield, 16% average dividend growth rate. That is freaking huge.
Yeah. I mean, can't really deny that. The dividend yield at 4.34%, again, down 43% this year. 25 bill by market cap, pretty big company. They've been through this before, guys. Again, to recap, 15 PE, 66% payout, 36 years of growing their dividend at an average rate right now of 16% with yield at 4.34%, which is over 3 times the S&P 500 pretty much.
Yeah, you hit it on the head right there, Lanny. They've increased it during the financial crisis, the tech bubble bursting, the S&L crisis back then. You know what? They've shown their ability to keep growing there. And even during the pandemic, that was 2 years ago, they still found a way to keep increasing here. So that's why T. Rowe's on my watch list. I'm excited. You might see it in our purchase video that's going to pop up later in the week as a few shares we nibbled on as the price came down. Again, looking to add maybe 1 to 2 shares of T. Rowe continuing going forward as the price hovers in this range.
Exactly. I mean, guys, anytime you can get, again, we're focusing on Dividend Aristocrats here. Anytime that you can really get a good look at a Dividend Aristocrat at these metrics, definitely keep them on your watch list. Obviously not professional or, any personal finance advice, but I know we're more than likely buying at these prices.
Let's move to Dividend Aristocrat number 2 here. Medtronic, ticker symbol MDT. The stock that's been all over our YouTube channel for the last month and a half. Lanny kicked off the Medtronic purchase party. What was it? A month and a half ago, Lanny, by starting that position and building it up. I waited about a month longer than last week. I just threw down, grabbed 10 shares and have been slowly building up my position ever since. And you know what? Since I purchased, the price keeps coming down. My first purchase was 78. I grabbed on to 80 and it's now in a much lower point. So you know what? Why wouldn't Medtronic continue to be on my watch list? We talked about them as aristocrat. These are 2 aristocrats that are on my watch list. So I am so pumped up to keep slowly looking at Medtronic as a position to build going forward.
Again, the numbers speak for themselves. A dividend aristocrat with over 44 years, almost a dividend king at these levels. I mean, for all the investors out there, beginning dividend investors, this is a great company in the healthcare, medical supply and equipment space here. And wow, I mean, again, they're down 28% this year, down 24% in the last 52 weeks, over $100 billion by market cap company here, currently trading at $76.72. Analysts are expecting right now $5.27 going forward. So Bert, hit them hard with that first metric, that price to earnings based on these numbers.
Their PE ratio is 14.56%, much like T. Rowe. Again, not the cheapest, but still a discount compared to the market. Moving into that payout ratio, $2.72 annual dividend. That's a perfect dividend payout ratio of 51%. Again, we shoot for 60%, but we think a perfect payout ratio is between 40 to 60%.
Now, let me tell you something about this dividend growth rate, brother. 44 years of growing dividends at an average rate of 8%, solid across the board right there. And I don't see any reason why they can't keep that revenue and track record of growing that dividend up. And Bert, that dividend yield, that little cherry on the top, now well over 3%, over 3.5%. In fact, they're at 3.55%, the dividend yield. So that combination with growth is so solid.
Yeah. Again, similar to T. Rowe Price, great stock that's been there, that has done this before in a sector too. Healthcare is not going away. If anything, it's just going to keep getting more important and higher revenues in this overall sector as more people continue to age.
Exactly, guys. So again, to summarize, 14.5 PE ratio, 52% payout ratio, 8% average dividend growth rate for over 40 plus years, 44 plus years, at a dividend yield of 3.55%. Two solid, undervalued dividend aristocrats right now. These could be great dividend stocks to buy. And Bert, what the community wants to know is what you doing, brother.
I'm going to spring this one on you, Lanny. So be ready. I've been looking to replace Johnson & Johnson every single Monday. With that, we were buying Johnson & Johnson was in the mid 170s towards the end of the weekly purchases. I haven't really found something. I've said when I do my purchases, I want, great quality stocks in my portfolio to keep building positions. Guess which two companies check that list? T. Rowe Price.
AT&T and Tesla.
Yeah, exactly. Both of those, not Tesla, AT&T for sure. But if you look at the two of them combined at the share price, 110, 76, that's about 187. It's close enough to the Johnson & Johnson weekly purchase. We're putting that in there Monday. As long as these two companies hover around this piece, for my wife in the foreseeable future, these are going to be her Monday purchases. One share of T. Rowe Price, one share of Medtronic every single Monday with a few extra shares sprinkled in there.
Damn, there you guys have it. It's happening. It's in place now. Welcome to the Medtronic Club as well, Bert, and all the dividend investors. I know you guys have been loving Medtronic lately. Are you buying these two dividend stocks? Let us know in those comments. Guys, again, we're gearing in, heading into the holidays here. 1 week to go until Christmas. Feel free to check out the spread shop below to get yourself some Dividend Diplomat swag. Subscribe to this channel, guys. Let's get this going here. Let's all get to financial freedom and better our personal finances together.
If you're not with us, you're against us, right, Lanny?
Oh, man, Bert said it there first. And guys, that was Bert and Lanny from the Dividend Diplomats. Over and out.